The Property Bulletin by London Property, the home of superprime.
The UK government has introduced updated financial guidelines for visa applicants, which will take effect from January 2025. These new requirements affect those applying to study or work in the UK. Applicants must now demonstrate at least 11% more in financial reserves than previously required. This adjustment is aimed at addressing concerns regarding immigration's impact on housing and the economy. Visa applicants must ensure that the required funds have been in their account for at least 28 consecutive days, without falling below the specified amount. These changes are detailed on the UK government's official website. Prospective students and workers from India and other countries should prepare for these new financial thresholds as they plan their applications. Heat networks are poised to play a crucial role in the UK's journey towards net zero, yet they remain somewhat enigmatic to many. Despite supplying heat to over 1 million people across the UK, there is still a lot of uncertainty regarding them. A new consultation aims to gather feedback from landlords, property owners, tenants and other stakeholders on consumer protection and the compliance requirements for heat network operators and suppliers under a new regulatory framework. Leslie Nugent, OFGEM's Deputy Director for Heat Networks, sheds light on what heat networks are and the implications of this new regulatory consultation for landlords. Heat networks supply heat and hot water from a central source to households and businesses through a network of pipes, explains Leslie. There are two types of heat networks: communal heat networks, which serve consumers in a single building, and district heat networks, which supply heat to more than one building, often over large areas. Communal heat networks are the most common in the UK, and both have the potential to decarbonize heating systems and support net zero goals. For landlords who run or own properties within a heat network, it is essential to understand the regulatory responsibilities. Ofgem and the Department of Energy Security and Net Zero, DESNZ, are developing a new regulatory framework for heat networks. Building owners are likely to be the operators of heat networks within their properties, making it crucial to stay informed about these regulations. In Scotland, there will also be a consenting and licensing regime for most heat networks, with consultations expected in the new year. Contact us at ask@londonproperty.co.uk to ask for the relevant links in order to participate in the consultations. Additionally, Ofgem and DESNZ will host online webinars to provide more information on the upcoming regulations before they come into effect in early 2026. Staying informed and actively participating in these consultations will help landlords navigate the evolving landscape of heat network regulations, ensuring compliance and contributing to the UK's net zero goals. The UK property market is facing a seismic shift, where buying a home becomes a luxury. According to economics reporter Melissa Lawford, Angela Rayner's ambitious plan to build 1.5 million homes over the next 5 years encounters a significant challenge: the economics of construction. Despite the UK's pressing need for housing, developers may find it financially unfeasible to build these homes. Ian Jenkinson of CBRE highlights a major issue. Only 50% of planned homes get built due to high construction costs and limited selling prices. Factors like interest rates, material costs, and market supply impact these decisions. Although demand for homes is high, affordability limits how many people can buy, capping the number of homes developers are willing to build. Councils face financial crises and cannot scale up building. Housing associations are burdened with safety costs post-Grenfell. To meet Labour's pledge to get Britain building, Rayner must confront the reality that mass home ownership may no longer be viable. Many new homes will likely be rentals rather than for sale. Pension funds, unlike private developers and councils, are eager to build, but prefer rental properties for steady income and asset growth. Bill Hughes of Legal & General suggests institutional capital could fund a significant portion of the needed homes. These funds seek long-term, inflation-beating returns, which rentals provide better than sales. The future may see a shift towards build-to-rent developments, where institutions build and manage rental properties long-term. This sector is less regulated than social housing, with no rent caps, making it attractive for investors. The UK's build-to-rent sector is currently small but has enormous growth potential, similar to trends in the US and Western Europe. Chancellor Rachel Reeves has opened doors for increased housing investment. The 2022 Subsidy Act allows for long-term government investments in housing, potentially providing equity or cheap loans to support build-to-rent projects. This could drive institutional finance into housing delivery, fundamentally changing the property market. If Rayner's plan succeeds, it will signal a shift where home ownership becomes a luxury and renting becomes the norm. The market will adapt with new types of homes and tenures, reflecting economic realities and investor interests. GCC investment in UK properties is set to surge in 2025. Gulf investors are expected to spend over $4 billion annually on UK real estate. The UK property market, renowned for its stability, high returns and global reputation, has long attracted GCC investors. With favourable economic conditions lining up, 2025 is poised to see even greater growth in this trend. Research from the Bank of London and the Middle East, BLME, a Sharia-compliant bank, indicates Gulf investors will likely spend over $4 billion annually on UK real estate. Key factors driving this surge include falling interest rates, a heightened focus on sustainability, and a stable market environment. A major catalyst for increased GCC investment is the forecasted fall in UK interest rates. The BLME report highlighted that 87% of respondents cited lower interest rates as a primary motivation. Recently, the Bank of England reduced its base rate by 0.25 percentage points to 5%, the first cut since 2020. However, it's crucial to note that mortgage rates are influenced more by the swap rate and broader market conditions than the base rate alone. The UK's economic stability enhances its appeal. The BLME report suggests that stable inflation and targeted opportunities in specific property sectors create an environment conducive to long-term returns. Coupled with political stability post-Brexit, the UK presents a more predictable and attractive market compared to other European nations, especially in resilient key city centres. The UK's chronic housing shortage presents another golden opportunity for GCC investors. Population growth, alongside increasing numbers of international students and professionals in urban centres, drives high demand for housing. Data from the Higher Education Statistics Agency, HESA, reveals a near doubling of UAE students in British institutions over 5 years, underscoring this trend. Environmental, social and governance, ESG factors, are reshaping the real estate landscape. GCC investors are increasingly aligning their portfolios with these global trends. Upgrading properties to meet sustainability standards not only complies with regulations but also proves profitable. BLME research shows that green-certified buildings can command a sales price premium of 8 to 18% over non-certified counterparts. As we move into 2025, the UK remains a top choice for GCC investors, driven by falling interest rates, increasing affordability, and a growing focus on sustainability. Investors are expected to continue focusing on high-demand residential properties and eco-friendly developments in key regional hubs, aligning portfolios with market demands and sustainability trends. With steady returns and long-term potential, the UK property market offers a unique opportunity for Gulf investors to expand their portfolios, tapping into housing demand and boosting property values through green investments. The UK remains a top-tier investment destination, promising steady returns for years to come. If you dread your parents' Christmas visit, the thought of them living with you may seem terrifying. But multi-generational living is on the rise. Factors such as Britain's ageing population, families having children later in life, and financial challenges young people face in affording rent or buying a home are contributing to this trend. Increasingly, families find themselves caring for elderly parents and young children simultaneously, and living together can be a practical solution. Multi-generational living is common in cultures like the Middle East and Africa, where it's seen as a cherished aspect of home life. For instance, a successful Asian financier in North London lives with his wife, children, brother's family, and elderly parents, 12 people in total. This trend is shaping the UK housing market as families look for ways to bring different generations under one roof, consolidating purchasing power and sharing costs. With high stamp duty, buyers are looking for properties that can accommodate their families for longer periods, often 10 years or more. This includes the ability to host children returning after university and parents moving in later. Flexible living is key, such as a spare bedroom or annex that can serve various purposes over time. Consider space for an extra bathroom, separate entrance, or even a lift for those with larger budgets. Self-contained living spaces on separate floors can offer independence for teenagers or grown-up children. In London, townhouses with separate basement entrances provide privacy and togetherness. A large kitchen and dining area that can accommodate shared meals is essential, as is a decent utility room with multiple appliances like washing machines, dryers, fridges, and dishwashers. Loft extensions are ideal for boomerang children, offering them independence at the top of the house. For grandparents, ground floor accommodations are preferable due to mobility concerns. A small separate kitchenette can provide grandparents with a peaceful retreat. Some families adapt their existing homes, while others combine resources to buy a new property that better suits their needs. This is often driven by pivotal life moments, such as elderly parents falling ill, or a growing young family needing more space. Pooling resources is a commercial arrangement requiring a legally sound agreement to cover all eventualities. Consult a good lawyer to manage ownership structures and future inheritance tax liabilities to avoid unexpected tax bills or fractured relationships. Set practical ground rules in advance, including childcare, housework, grocery shopping and laundry schedules. Don't assume everyone has the same habits or expectations. Consider a household bank account for shared bills and agree on contributions. Multi-generational living isn't for everyone, but setting ground rules early and pooling resources to buy a suitable home can make it fun, rewarding and financially beneficial.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.